Hey guys, Toby Mathis, and we're going to talk about avoiding these common mistakes on your next 1031 exchange. A 1031 exchange can be a game changer for real estate investors looking to save money and grow their portfolios, but it's not as simple as it seems. In fact, there are common mistakes that many investors make that can end up costing them big time. In this video, I'll reveal the top missteps to avoid and offer expert tips to ensuring a successful exchange. Whether you're just getting started in real estate investing or you're a seasoned pro, this video is a must-watch before your next 1031 exchange. So let's just start here. What is a 1031 exchange? Well, in its simplest form, it's exchanging investment real estate for more investment real estate of equal or greater value. If you do this, there's no recapture of depreciation, there's no capital gains. Even if you cost seg a property, nada. Even if the real estate used to be your home. So long as it's investment real estate when you sell, you are good. But just know, here's number one, you must use a qualified intermediary to take title or hold funds. And then depending on the type of exchange, you get all sorts of other issues. So let's talk about mistake number one. Numero uno, failing to meet the strict timelines. There are four types of exchanges. There's a simultaneous exchange where I just swap properties with somebody. There's a delayed exchange when you sell and then later buy a replacement property with a slight delay. This is the most common. It's called a starker exchange. Then there's a reverse exchange. Hey, I buy the property first and then I sell a property, and then there's this improvement. You sell and then refurbish or build a new property. In all of these, you have a 180-day timeline to complete the exchange. From either the sale and the purchase, for the simultaneous swap, which that's easy because you're obviously going to be there. If you're doing a reverse exchange, it's from when you bought the property or when you sold the property and you're buying a new one. If you're doing an improvement, you have 180 days to complete it. And whatever the case, you have to, like let's say it's a delayed exchange, you have to sell the property and then you have to identify a replacement property within 45 days and close on it within 180 days. You miss the date, you lose the benefits of the exchange. On all of them, there's a 180-day exchange. On that simultaneous, easy peasy because you're doing the exchange, you're using a qualified intermediary, and you already have the property, you're doing swap for swap. It might be one property, it might be two properties, you might be swapping one for three, might be swapping one for two, whatever, but it's simultaneous. When you do the delayed exchange, you have that 45 period to identify properties. We'll get more on that in a little bit. And you have 180 days to do that exchange. Reverse exchange, you have 180 days from the acquisition to the sale of the first. On the improvement, 180 days to complete that improvement as the replacement. Mistake number two is not identifying replacement properties properly. As the exchanger, you are required to provide in writing an, quote, unambiguous description, end quote, of the potential replacement property or properties by midnight on the 45th day after close. You give this to your qualified intermediary in most cases. A legal description or property address will work. What if you want to buy several properties or not sure which properties you want to buy out of several different options? If you wish to identify or purchase multiple properties, you must do one of the following. You ready? Identify up to 3 properties of any value with the intent of purchasing at least one. Number 2, you could identify more than 3 properties, but their aggregate value cannot exceed 200% of the market value of the relinquished properties. That's tough. You can identify more than 3 properties with an aggregate value exceeding 200% of the relinquished property, but you have to know that 95% of the market value of all the properties identified must be acquired. So I'd have to buy a lot more, but I could identify more than 200% if I had to do more than 3 properties. So I sell 1 property, identify 4. I just have to be careful that I'm not hitting that 200%. Or if I identify 4, that I buy at least 95% of the value of those properties. Really, I just have to buy all 4. So for people doing an exchange, of a massive exchange where they're identifying 20 replacement properties, you just got to know, hey, I'm buying at least 19 of those, right, to make it work, or the value has to equal 95%. So, you know, if they're all of equal value, you're buying 19. Next one, work with your qualified intermediary, also called a QI. That is who you identify through. You got to make sure that you're working with them and that they know these are the replacement properties. Chances are they're going to be on you like white on rice, making sure that you're getting this done, because they're very, you know, like they're acutely aware that you have this timeline. They also are the ones receiving the money. And I'll get into more of that a little bit later. Mistake number 3 is not understanding the 1031 exchange rules. Number 1, it must be real estate. It can be land, it could be commercial property, single family residences, condo, etc. Any mix. It cannot be personal property. You're not exchanging cars. You're not exchanging your company. You're exchanging real estate, and it must be investment property. No, you cannot exchange a personal residence unless you make it into an investment property first. Then you would have to buy an investment property. Let me get back into that one. If I do a personal residence and I want to make sure that it qualifies for an exchange, what I would do is I would move out of that property and rent it and make it into an investment property. Now, I have I actually have 3 years. I have to, in order to meet the capital gain exclusion, when I sell my personal property, there's something called Section 121. And what it does is it gives you a $250,000 capital gain exclusion if it's your personal property and you're single, or up to $500,000 if you're married filing jointly and you sell a personal property. I want that. I need to live in it 2 of the last 5 years. Not the last 2 years, 2 of the last 5 years. So if I take 2 and subtract it from 5, what am I left with? 3. So I could move out of my home, and as long as I sell it within 3 years, and as long as I lived in it 2 years, I would qualify for my capital gain exclusion. Let's just say that I'm married, it's $500,000. And so I move out of the property, I make it into an investment property, and then I sell it, and I buy more investment property. I would have a step up in basis. This is what's weird. I would actually get a step up in basis on that property for the $500,000. So when I exchange, my basis in the new property is actually $500,000 more than the exchanged property. And then I would buy, and I would also get a 1031 exchange, and I would move that into the new property. So it absolutely works. So I'd have to buy an investment property when I'm exchanging it. I can even have a great big investment property that I buy with the intent that I'm going to make it my personal residence at some point in the future. As long as when I sell that it's an investment property and I buy it's an investment property, then I am A-OK, and I can actually double up that 121 and the 1031 exchange. Now this is really important. I'm going to say this very slowly. You must exchange into the same name. So if I sell an LLC, let's say I'm selling a property in an LLC, so the title holder is ABC LLC. The title holder of the new property must be ABC LLC. We see this from time to time when somebody's exchanging, for example, a commercial property. They may do an LLC, let's say it's ABC LLC, they sell a building and they want to do an exchange, they get a qualified intermediary, and they're going to buy a new building in a different state. Has to be that same LLC. What you'd more than likely do is foreign file it into the new state where the new property was, but it has to be that. And this is why it gets really interesting when you do syndications and stuff. Unless everybody agrees, right? You're not going to be at a 1031 exchange through that syndication unless everybody agrees, hey, we're going to go buy this other property. More than likely, like 99% of the time, they're not going to do it. Usually they're going to exit that syndication, close it down, you're done, you take your money. There's no way to do the 1031 exchange. If you have partners, then you get this thing called a drop and swap or a swap and drop, but you're getting rid of the person after the sale because you need to go same name. If it's an individual, it must be the same on the sale and the purchase. That's important. And you absolutely must use a qualified intermediary, a QI. You cannot touch the money. If you sell and take the money and the next day you decide to do an exchange, nope, you cannot do it. So there we go. We explained some of the specific rules and requirements of a 1031 exchange. It's the like-kind property requirement. We talked about the, if you're buying from the same name, that you have to know that the seller knows that you're in exchange. Here, I'm going to give you guys a quick one. If the seller knows you're in an exchange, make sure that you have a backup. In other words, if I'm selling my property and now I'm buying something else, the new seller, somebody who's going to sell me that property, if they know I'm in a 1031 exchange, they may start playing games with you, especially in the commercial realm. They may say, hey, we want you to waive this or we want you to waive that. Like let's say you're trying to make changes to the property after an inspection. You say you need to fix this and the other. They may just say, nope, not going to do it. Why? Because they know it's going to cost you if you do not close on that property. So make sure that you have backups, because there are people who will play games with you if they know you are on a timeline and face adverse tax consequences. All right, mistake number 4 is failing to properly calculate the tax implications of a 1031 exchange. An exchange means your basis is not changing unless you buy a property that has a greater value and a greater deductible basis. This means you depreciate at the old basis, not the new basis, unless you spend the money. You also know that debt has nothing to do with it unless you cash out of the deal. If you take cash out of the deal, in other words, add more debt and you're taking more, that is called boot and it's taxable to you. You gotta just understand these rules, work with your QA. Mistake number 5 is not having a clear investment plan. Are the benefits of the 1031 exchange greater than losing the added depreciation? Did you actually run the numbers? Are you working with a good qualified intermediary and know what type of property you might want to buy before you sell? There's Delaware statutory trust that could actually be used in lieu of buying real estate. There are tenant in commons transactions that you can do. There's even a way to do a Delaware statutory trust into a REIT. And you just got to know what are your options of what you can do with the exchange proceeds in order to qualify. So there we go. We just went over all the common mistakes that you make. I think we went over 5 of them. Everything from the timing, identifying the right properties, knowing the rules, knowing the benefits, making sure it's right for you, having a clear understanding. And I'm just going to give you one last little tip. Work with a good QI. Know exactly what your exit is before you enter, and make sure that when you are doing this that you have a clear plan and you know the consequences of failing to make the exchange. If you do this, you will not be disappointed and you can get some great benefit. And here's the last thing I'll tell you. You can exchange properties throughout your life, so you can do multiple 1031 exchanges. I could exchange into a property, then I can exchange that property into more property. I can exchange that property into more properties. And if I never want to pay tax on it, if my heirs never want to pay tax on it, all I have to do is hold that property until I die. Do not gift it to your heirs. If I hold that property, when I pass away, my basis steps up to the fair market value when I pass, and there's no depreciation recapture, there's no capital gains, there's no tax. Voila, it's all forgiven. I have a new basis at the fair market value. My heirs can even redepreciate it at the new higher value. That's why 1031 exchange are so potent. Hopefully now you know a little more about them, and you can make sure that you're going in with your eyes open and you know the common mistakes that occur in a 1031 exchange. Hey, if you guys like this type of information, please subscribe and click that bell so that you're notified when new videos come out. And if you think there's anybody that you know that could benefit from this information, please share it.